From the trading desk of dailyforex.com, this is Christopher Lewis looking at the euro dollar pair coming up for the October 25th session. As you can see, and we're just shortly before closing time, the market fell during Wednesday, but bounced significantly just above the 129 level to form a hammer, which I would have as an epicenter, say 129 or so. You can see that previously, 129.50, excuse me, you can see previously that this area has been a resistance a couple of times. So the fact that it would offer support right now isn't that big of a surprise. Now, having said that, you have to keep things in perspective. We have sliced through it a couple of times before, so this isn't exactly like the wall that can't be breached here. Truth is it's just an area where you would expect to see a possible reaction, and that's what we've gotten. At the end of the day, we formed a hammer, so we have to look at it as such and recognize the fact that if we break higher, that is a bullish sign. The question at that point is can we get above the 131.50 level? Very possible, but looking at the longer term charts, there is a ton of noise above 131.50 heading to the 135 level. And as such, I'm not a huge fan of buying the euro and hanging on to the trade. This could be another, like we see here, a burst up, another burst up. That's very possible. So this would be a short-term long. Now, having looked at this chart and kind of studied it for a while, you can see that I have the, this is actually the 50 EMA. And a lot of traders will follow this. I'm not such a moving average trader myself, but I know that a lot of people pay attention to them, so it's kind of a self-fulfilling prophecy. And you can see we're kind of walking the line here with the 50. For a point of reference, the 200 is doing something like this right now. So there is a precedence for this to continue to get support. However, having said that, with all the things that are going on right now, a break of the bottom of the hammer is always a negative sign. If you're a little bit more aggressive, this could be a time to short. However, 128 offers support. So for myself, as I tend to look for a little bit longer term trades, I'd be very aggressively short below 128 because this would show a couple different things. It would show this consolidation failing. It would show that the highs got lower and then the lows suddenly got lower, and would be with the overall trend when you look at the last couple of years. There are plenty of headline risk in Europe, so this would not surprise us. However, if we get that request for a Spanish bailout, this would probably spike the value of the euro. Ultimately, it would weaken it because they would have to print euros. But in the meantime, it would cause this huge, massive relief rally, and that could be a catalyst to throw us right through 135 like it wasn't there. But in the meantime, until we get that announcement, there is a ton of noise up here. So again, it's going to be hard to be longer term buy and hold. It definitely would be okay to, at least for my comfort level, to go along and for a short-term trade, and I would definitely be much more comfortable on the short side as it makes more sense from a fundamental standpoint.